continue from where we left off. We're looking at the Standard Multi-Manager Balance Fund, and in the previous video, if you haven't watched part 1, this is going to be part 2. Part 1, I've spoken about this overall fund info, which is this first section here. We'll now move on to the second section, which is asset allocation, assets under management. And if you've watched the video on the ASISA category, you would have seen this asset allocation chart, which shows you the average allocation of all the funds in ASISA category in aggregate. Okay, what this chart does is show you that same average for the ASISA category, which is the sort of the line on the bottom, versus the fund, which is the line on the top, and the numbers are side by side here. So the fund first, and then the category. So just using this first line as an example, local cash, the fund is 3.3% in local cash, whereas the ASISA category has 6.5%. So relative to the ASISA category, it's underweight local cash. Then you've got bonds, property, equity, etc., all the way to the bottom, and then you've got the summary here for local assets. So roughly in line with the ASISA category, the split between local and global assets, but on the equity side, quite a bit higher. So 70% total equity versus 60% for the ASISA category. So about 10% overweight equity, representing probably a bullish view on equities in total, local and global combined. The next chart is the assets under management over time, and you can see it was fairly flat until 2014, where we got a massive injection. We took a whole bunch of life assets and put them into our collective investment schemes, and our balance fund was a big beneficiary of that, got about 4 billion in, and you can see that the assets have increased nicely over time. I'm going to ignore this chart. It really looks for a relationship between returns and cash flows. In other words, does money flow in and out dependent on the returns that have happened for the fund. So just ignore that chart for now. And then we start getting into the performance of the fund, so peer relative performance of the fund. So peer relative because we compare the performance of the fund against the category median and the category average. Now in quartile terms, we've basically got 4 colors, which you can't see here because this fund doesn't have performance in the 4th quartile. The dark green, you'll see 1st quartile, light green 2nd quartile, a bright sort of red is 3rd quartile, and then a dark red would be 4th quartile performance. And this is the period, so over 1 month. In other words, for January 2023, this would be 3 months to January. This would be 6 months and 1 year, all the way. This fund's got 20 years of data. This final data point is if a fund had, for example, 3.5 years, it would have numbers coming down to 3 years, but nothing for 4, 5, 10, 15, and 20. But here, it would have the 3.5 year number. So whatever that is, 42 months, it would appear at the bottom here. So you can see what the fund gave you, what the median gave you. And, if you know quartiles, it's the top 25% of sort of sorted performance numbers would put you in the top quartile. So in this case, you can see, for example, 51 out of 201 just makes it into the top quartile. Okay. Remember again, I've spoken about in part 1, there's an endpoint bias here, right? The end date bias, because all the performance, the 1 month is to January, 3 months to January. So it all depends on the recent performance. I mean, obviously 20 years doesn't depend a hell of a lot on the last month, but there is that endpoint bias there. And then I also give you some rolling returns. In this case, monthly isn't rolling, it's every single month over the past 20 years. What's the lowest single month and the date? What's the highest single month and the date? What about over rolling 1 year periods? What's the lowest and what's the highest? So this fund to April 2006, we had that massive bull run, gave you 51.4% over that 12-month period. And the worst, period, and you can see a little red dot there, would have been during the GFC, the global financial crisis, where over a 12-month period it lost 21.8%. All the way out to 15 years, obviously it's pointless having a 20-year point because it would just be a single number. There'd be no rolling because I only carry 20 years of data here, but I also just give you a 3-year rolling volatility number here as well. Okay, let's do maybe one more section, which is these full period return charts. So again, for this fund, you've got 20 years of data. Another fund might only have 12 months of data. So what I show you here, and I do this with a lot of the graphs, right? I show you nominal returns, in other words, the actual return achieved by the fund, and then active returns, which is the return of the fund versus some benchmark. And again, the benchmark can be selected here. So it could be the category average or the category median or CPI or Steffi Call. This would be a overnight cash rate. Steffi Composite, which is longer than overnight. It's actually weighted to sort of 3-month cash and 6-month cash, etc. All be sort of constituents. And you can scroll along the bottom here, and there's a lot of indices here to choose from. Resi and Findi and Indy and Resi 10, and so you've got the MSCI World. You've got a lot of indices to choose from. But if we just keep it on the average, for example, or perhaps CPI, you can see the active returns versus CPI. So the green numbers would be, again, in the top graph here, are nominal returns, positive, and the red numbers would be negative on a monthly basis. Whereas these purple, orange, and cyan would be over whatever period you've chosen. I'm giving you 3 rolling periods in one chart. So in this case, it's 3 years, 4 years, and 5 years rolling. Sorry, I'm going to go back there. So you could decide, no, you want to look at rolling 1 year, 1 year, 2 years, and 3 years. So you could click on the segment with 1, 2, and 3 years. So you could see that over 1 year, how much it's lost at its worst and how much it's done at its best. Again, these numbers should tie up exactly to what I showed you in the numbers above. But for something like a balance fund, you probably want to look at longer time periods of 7 years to 9 years, for example, and you can get a sense for how those numbers have done. On the bottom one, again, on an active basis, in other words, how have these numbers compared to the ASISA category average? So obviously, if these numbers are positive, it's outperformed the category average for the month. If it's negative, it's underperformed. And I give you a little statistic here that just shows you the proportion monthly. Okay, never do this on rolling numbers, calculating the hit rate. People get this wrong. They do consistency and hit rates using rolling numbers. You can see these numbers here are not independent numbers, so you should never do that. Okay, it's never going to give you a stable statistics or meaningful sort of statistics. They should never be interpreted as sort of probabilities, even under appropriate assumptions. Whereas you can do that for the monthly numbers here. And I'm showing you a hit ratio of 61% of the time you had positive active numbers. In other words, this fund outperformed the ASISA category average 61% of the time. You can see in nominal terms, positive returns from a balance fund, or this particular balance fund, 67% of the time. Right, so scrolling down a little bit more, I'll cover just a few more graphs here, and then we'll end it off. In fact, let's end it off there. The video is long enough, and we'll carry on in part 3, covering more of this. Thanks, bye.